A 401k is just a special bucket your employer sets up where you can throw money in before the IRS gets to tax it. That's literally it. The reason it exists is because in 1978, Congress passed a Revenue Act which included a provision called Section 401k that gave employees a tax-free way to defer compensation. A benefits consultant named Ted Benna noticed a loophole, built the first actual 401k plan around it, and corporate America used it as an excuse to dump pensions and shift retirement onto regular workers. That's how we got here. The bribe works like this. Every dollar you put in your 401k skips income tax that year. So if you make $70,000 and put $7,000 into a traditional 401k, the IRS only sees $63,000. You don't pay tax on that $7,000 until decades later when you actually pull it out in retirement. That's the whole pitch. Now here's where most people completely miss the point. The single most important thing about a 401k isn't the tax break, it's the employer match. A 401k match is a special benefit your company puts into your 401k based on what you contribute. Often this matches 50 cents or $1 for each dollar you contribute. There's also often a cap on the amount your employer will match, such as 6% of your total pay. So let's say your job offers a 100% match up to 6%. If you make $70,000 and put in 6%, that's $4,200 of your own money. Your employer then drops another $4,200 in there for free. You just doubled your money before any investing even happened. If you don't contribute enough to get the full match, you are literally turning down free salary. It's the highest guaranteed return you will ever see in your life. Nothing in the stock market, in real estate, in crypto, in anything beats an instant 100% return. So step one is always the same. Find out what your match is and contribute at least enough to get all of it. If you do nothing else with this video, do that. But there's a catch with the match called vesting. Vesting just means how long you have to stay at the job before that match money is actually yours. Some companies vest immediately, meaning the second they put it in, it's yours. Others use a graded schedule where you get 20% per year and you only own all of it after 5 years. And some use cliff vesting, where you get nothing if you leave before 3 years and 100% if you stay past it. So before you quit a job, check your vesting schedule. People leave thousands of dollars on the table every year because they didn't wait an extra 2 months. Then there's the next decision, traditional versus Roth. Most 401ks let you pick between the two, and people overcomplicate this. Traditional means you skip taxes now and pay them when you withdraw in retirement. Roth means you pay taxes now and never pay them again. Not on the money, not on the growth, not ever. The simple rule is this: if you think your tax rate will be higher in retirement than it is right now, pick Roth. If you think it'll be lower, pick traditional. Most people in their 20s and 30s making average money should pick Roth or split between both because their income is probably going to climb. People deep into a high-paying career should lean traditional because they're getting taxed hard right now and will probably spend less in retirement. There's no perfect answer, just pick something and start. Now the actual contribution limits. For 2026, the amount individuals can contribute to their 401k plans increased to $24,500, up from $23,500 for 2025. If you're 50 or older, you can throw in an extra $8,000 on top, so $32,500 total. If you're between 60 and 63, you get a special bonus called the Super Catch-Up that lets you put in an extra $11,250 instead of the $8,000, so $35,750 total. The combined limit, meaning your money plus your employer's contribution plus anything else, caps out at $72,000 for the year. And there's a new rule that just kicked in. If you earned over $150,000 in 2025, your catch-up contributions now have to be designated Roth contributions. They can't go into traditional anymore. So high earners over 50, take note. Here's the part that actually matters once your money's in the account. Your 401k is not an investment, it's just a container. The money you put in sits there doing nothing until you pick what it's invested in. This is where 90% of people screw up. They sign up, set their contribution percentage, and never look at where the money's actually going. Sometimes it just sits in cash and earns nothing for years. Sometimes it gets dumped into the default option, which is usually a target date fund. A target date fund is basically a one-decision investment. You pick the year you want to retire, like 2055, and the fund automatically invests aggressively when you're young and gradually shifts to safer stuff as you get older. For most people, this is fine. It's not optimal, but it's fine. The other option, which is usually better long-term for people who actually pay attention, is picking low-cost index funds yourself, like an S&P 500 index fund or a total market fund. The thing nobody talks about enough is expense ratios. Every fund inside your 401k charges you a fee expressed as a percentage. Anything over 0.5% is high. Anything over 1% is robbery. A 1% fee sounds tiny, but over 30 years, it can eat a quarter of your entire retirement balance. So when you're picking funds, look at the expense ratio first. Cheap and boring almost always beats expensive and fancy. Picture it like this. If two people invest the same amount and earn the same return, but one pays 0.05% in fees and the other pays 1%, the cheap one ends up with hundreds of thousands of dollars more at retirement. Same investment, same returns, just less leakage. Now, what happens when you leave the job? This trips a lot of people up. Your 401k doesn't disappear. You have 4 options. You can leave it where it is if your old plan allows it. You can roll it over into your new employer's 401k. You can roll it over into an IRA, which usually gives you way more investment options and lower fees, or you can cash it out, which is the worst possible move. If you cash out before age 59 and a half, you pay regular income tax on the entire amount, plus a 10% penalty on top. Someone who withdraws $25,000 at age 42 with a 22% federal bracket and a 5% state tax rate ends up losing about 37% of it once you stack the penalty, federal tax, and state tax together. A $50,000 cash out can easily leave you with around $30,000 after the IRS finishes with you. People do this all the time when they switch jobs, and it's the single biggest wealth-destroying move in personal finance. Just roll it over. It takes one phone call. There's also rules around when you can actually use the money. The standard rule is you can start pulling from your 401k without penalty at age 59 and a half. Pull anything before that and you eat the 10% penalty plus regular income tax. But there are exceptions. There's the rule of 55, which says if you leave your company in the year you turn age 55 or later, you can pull from that employer's 401k penalty-free. Permanent disability gets you out of the penalty, certain unreimbursed medical expenses do too, and under Secure 2.0, you can now take $1,000 emergency withdrawal per year without the penalty. And once you've done that, you can't take another for 3 years unless you pay back what you withdrew. There are also penalty-free exceptions for qualified birth or adoption expenses up to $5,000 per parent for domestic abuse victims and for those with a terminal illness. None of these waive the income tax. They only waive the 10% penalty. And then on the other end, the IRS forces you to start taking money out at age 73, whether you want to or not. These are called required minimum distributions. Beginning in 2033, the RMD age will increase to 75, so anyone born in 1960 or later won't have to deal with this until then. And here's a useful update most people don't know about. The Secure Act 2.0 eliminated RMDs for Roth 401k plans effective 2024. So if your money's in a Roth 401k, the government can no longer force you to pull it out during your lifetime. That's another point for Roth. So if I had to compress this entire thing into the moves that actually matter, it's this. Contribute at least enough to get the full employer match, no exceptions. Pick Roth if you're young or expect higher taxes later, traditional if you're a high earner now. Check your vesting schedule before you quit, pick low-cost index funds or a target date fund and stop touching it, watch the expense ratios, roll it over when you leave a job, never cash out, and bump up your contribution by 1% every time you get a raise. You won't feel it, and in 30 years, that one habit alone makes you hundreds of thousands of dollars richer. The reason most people end up with terrible 401k balances isn't because the system is rigged or because they didn't make enough money. It's because they signed up, ignored it for a decade, and let the default settings cook them. The system actually works really well if you just pay attention to it for 10 minutes once a year. That's it. That's the whole game.